Hello, and welcome back to the demo portion of stock or accounting for stock investments. First exercise I want to go over is exercise 16-5. Looks like that's on page 714. And it says Nosker Incorporated had the following transaction pertaining to investments in common stock. So it looks like that Nosker purchased 5% of Escalante's corporation common stock. So right off the bat, we need to recognize that it says, hey, they own 5%, right? 5% or owning 5% of a company stock does not give us significant influence over the investee, right? So we're going to account for this method using the cost method. So it tells us on January 1st, we purchased 2,500 shares of Escalante Corporation common stock, it's 5%, for $152,000 cash. Okay, that's not a problem. We can do that. We're using the cash method. So hopefully in your notes, or you remember that we need to debit stock investment, credit cash. That's the journal entry. Okay? So let's make it so. So they tell us that on January 1, we purchased stock. So we need to hit stock investment of $152,000, and we need to credit cash for $150,000, right? Now, some of you might wonder, hey, what is the description here, right? Well, it could be whatever we make it, right? So I would take some of the important details out of the problem in the book and kind of put them as our explanation, okay? Bought 25,000, and then I'm going to say in parentheses that's 5% of Escalante Corporation. Okay, good enough. All right, always skip a space between your journal entries. The second one says we received a cash dividend of $3 per share. Well, we are using the cost method here. So on July 1, we're getting a dividend. Since we're using the cost method, we need to recognize dividend revenue, right? So what are we getting? Cash. How much? Well, we're getting $3 per share. And we own 2,500 shares. That means we're getting $7,500 in cash. Okay. We need to credit dividend revenue. Again, I'm crediting dividend revenue because we own 5% of the stock, right? We have to use the cost method, right? Okay. So on December 1st, we sold 500 shares of Escalante Corporation common stock for $32,000 cash. Not a problem, right? We can do that. So first thing we're going to do is recognize what is the journal entry. What do I have to debit? What do I have to credit? Well, think about it. We're getting cash, right? We're decreasing our stock investment account. And there's probably, I'm going to skip a space here and I'm going to say gain or loss, question mark, right? Because we don't know, right? We got to calculate it. So the cash that we received, the problem tells us, is $32,000. So I'm going to debit cash for $32,000 because that's what we have coming in. So we sold 300 shares, right? And we need to figure out what the cost of those shares are, because they didn't give us a per share cost, right? They just said we bought 2,500 shares and we got 150, or it cost us $150,000, right? We can divide to figure out what the market cost was. We could, or we could just say, well, let's think about this. We're selling 500 shares, right? So we own a total of 25,000. We're selling 500. It's probably that's 1/5, right? So to figure out how much the stock investment is going down, I'm going to take my value, which is $152,000, and then I'm going to multiply that by 1/5, right? Because that's how many, that's the fraction of shares that I'm selling. That ends up being $30,400. So we're getting more cash than the investment's worth. Guess what? We have a gain, right? So we need to credit gain on sale of stock investment. And all we have to do is just subtract the two, right? And if my math is right, that should be $1,600, and it is. Okay? So then they tell us on December 31st, we received the cash dividend of $3 per share. Fantastic. So we need to do the journal entry, right? What am I getting? Cash. What do I need to record? Well, they're paying a dividend, so I'm getting cash. Well, that must mean I have to credit dividend revenue. Okay. So how many shares of stock do I have? Well, let's see here. It said we bought 2,500 shares at $3 a pop, or the dividends at $3 a pop. Let's see here. 2,500 times 3. $7,500 in dividends. Sweet. Dividend revenue, $7,500. Now, I hope, stop, look at what we just did. We recorded a dividend, right? The journal entry is correct. Debit cash, credit dividend revenue. Something's wrong with that dollar amount. We need to keep track of the number of shares that we hold, okay? We originally bought 2,500 on January 1st. However, on December 1st, we sold 500 shares. We don't have 2,500 shares anymore. We have 2,000 shares. And then we see that when we fix the calculation, our dividend revenue is $6,000. Okay? The best advice I can give you is we use T accounts, right? And we need to figure out, or in the past, we've used dollar amounts to calculate, or the T accounts represented dollar amounts of the account, right? What's the value of the account? We should do the same thing with the number of shares, right? Meaning each time we hit the investment in stock account, we should create, this is just a record keeping for us to keep track, okay? There's nothing says you have to do this. This is just my advice for you. Here's what I would do. You always have to keep track of the number of shares that you have at any given point in time. Case in point, we bought some, we sold some, then a dividend came. Well, if we use the original amount, that's wrong, right? My suggestion is to keep a T account for the number of shares. That's it, right? Let's see, who'd we, this is what, Escalante Company, I think. Right? So let me show you what I mean by this. Okay. Let me go. Crap, bear with me here for a second. I just want to make us look so we can see it. Okay, so notice what happened, right? We debited $1,500 or $15,000 of that in that stock investment account, right? Credited cash. So we would have to post this to a journal entry, right? I'm not going to post the cash. I'm not going to create a T account for the cash. I'm just doing one side of these transactions, okay? So, well, I need to debit $150,000 to this account. Well, why not also create another T account and just shows the number of shares, right? It's just a method for us to keep track of the information, right? You don't have to do this if you're savvy enough to go back and look and say, oh, yep, okay, I bought 25, up down here I sold some. You're fine, okay? If you're having difficulty keeping track of the number of shares, use this method, right? Nothing says we can't do it, right? It's just for us to do our homework problems. Do they do this in the real world? I don't know, probably not. But I guarantee you they go back and count, okay, let me look at all my journal entries. How many shares are all these? Boom, 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 okay? So then July 1st, cash, dividend revenue, nope, nothing. Up. December 1st, I sold some stock, right? I had to credit this account $30,400. $30,400. How many shares did I sell? Well, I know I sold 500. So I'm going to come down here and say 500, okay? So you know then the balance after this is 2,000 shares. Okay. Another thing we could have done, and that would help us to determine the number of shares, underneath the, excuse me, here we go. Okay, underneath the explanation, we could say sold 500 shares Escalante Corp. Okay, so that way we could just look and say, oh, okay, I bought some, sold some. However you want to keep track of it is fine. The key takeaway here is we have to also reflect the fact that when the dollar value of these accounts are hit, the number of shares are also going to be impacted. Okay, let's look at exercise 16-7 next, and I put them right next to each other for a reason. 16, if you look at 16-7, and that looks like it's also on, oh, nope, that's on page 715. They tell us that on July 1st, Zabel Corporation purchased a 25% equity in Helbert Corporation for $180,000. Stop right there. 25,000 shares says that we have significant influence. We need to use the equity method. So I wanted to put them next to each other so visually we could see what journal entries we need to do, okay? And we'll do those first, and then we'll go back and compare and contrast, all right? So they told us that we bought 25% equity in the company, and that cost us $180,000, right? They tell us that Helbert declared and paid a $60,000 cash dividend, reported net income of $200,000. We got to journal the transactions. Okay, that's the first thing we're going to do. So let's think about it, right? What did they do? Well, on January 1, They bought the stock, right? So we're going to debit stock investment for the dollar amount of $180,000, and we're going to credit cash, right? We're just recording it at cost, right? When does that equity method come into play? Well, the equity method comes into play whenever we receive a dividend from the company that we have significant influence in, and when they pay, or when the end of the year when they have their income, right? We have to report a proportion of that. So they tell us that on December 31st, or let's pump the brakes here for a second. If you're wondering what explanation do I put here, here's what I would put. And again, there's no rhyme or reason. We just want to put enough information in there to tell us what's going on, right? Enough information that maybe we don't get just by looking at stock investment, debit, cash, credit, right? That says we bought investment in another company's stock, but I would say bought 25% of Halliburton Corp. Okay, so that tells me that 25% up. I got special accounting here. I got to deal, or a special accounting method I need to deal with. I got to use the equity method. Okay, so So now let's go to December 31. Right, the company paid a dividend. Okay, cool. We're still getting that cash, right? We're definitely getting that cash. So we're going to debit cash, but we need to credit stock investment. Okay, for how much? Well, let's think about it. The problem told us that they paid declared and paid a $60,000 cash dividend. We get 25% of that. Why 25%? Because that's our ownership in the company. If our ownership was 26%, we'd multiply it by 26%. If it was 29%, we'd multiply it by 29%. Okay, so what I'm going to do I'm going to show. Bear with me here. Sorry. So what I'm going to do is I'm going to calculate how much cash did we actually receive. Well, I know I got 25% of that corporation's cash dividend. So 60,000, the total amount of the dividend, times 25%. And the amount of that should be $15,000. I need to credit stock investment, $15,000. And again, if you're curious, hey, what should I do here? Well, again, we could say received 25% of Halliburton's $60,000 cash dividend. Okay. Now, they reported net income, right? Because we are using the equity method, we need to record 25% of that company's net income on our books. And we need to reflect that in our stock investment account. Okay? So, what I'm going to do here is on December 31, I am going to debit and credit something. What am I going to debit and credit? Well, remember, we're going to debit stock investments for, good Lord, I apologize, bear with me here. Okay, for 25% of their net income. Well, their net income was $200,000. So that must mean that my stock investments in Halliburton is going to go up by $50,000. What do I credit here? I need to credit revenue from stock investment, $50,000. Okay? Now, the next thing I need to do is I need to calculate what is the investment in Halliburton, however you want to say it. Well, first thing I'm going to do is say, well, the investment in Halliburton as of January 1 was $180,000. Okay. Well, don't forget, I need to subtract out the dividends that I received. How much did I receive in dividends? Well, it was $15,000, right? That's the 25% of the $60,000. Then I need to add the share of reported income, which is going to be $50,000. So, $50,000. So my investment in Halliburton on December 31 is $215,000. Okay? Now, that calculation we just went through, that should look very, very, very familiar, because that is identical to how we recorded the owner's equity section, or I'm sorry, the retained earnings section, or the statement of retained earnings, right? We started off, what was our beginning balance? We subtracted out our dividends. We added in net income, subtracted out our dividends, and then we got our ending balance. Same exact thing, right? Here's our investment in Halliburton, right? They paid us dividends, so that decreases our stock investment. They reported net income, so we got to add our share of the reported net income. We run the math, we end up with the ending balance, okay? Real quick, what is the difference between these two? Well, first, under the exercise 16-5, that's the cost method. We bought stock, debit, stock investment, credit cash. Under 16-7, which we use the equity method, we did the same journal entry. Debit investment, credit cash. Cool. Okay. Company pays a dividend, right? Well, under the cost method of 20% or less, we own, or say 19%, right? Or less. Under the cost method, we debit cash, credit dividend revenue. However, in exercise 16-7, which is the equity method, we do not record dividend revenue. We record an increase, we're paying a dividend, so we report a decrease in the stock investment account. Okay. We sold it. Well, we didn't sell any here, so nothing to worry about, right? Under the cost method, they did not mention anything about the shared portion of the reported income. That was only under the equity method. And under the equity method, we said that we need to debit stock investment because our investment, that stock investment account, is increasing by the amount of our share of reported income, and we need to credit revenue from stock investments. So not too bad there. Okay. When we come, actually, we're going to come back and we're going to finish up talking about the consolidated method, okay? And then we're going to work on an example and see exactly how we do that, okay? So please tune back in for that video.